Trump. Federal Reserve Chairman Jay Powell responding to the president during the FOMC press conference, emphasizing this. Political considerations play no role whatsoever in our discussions or decisions about monetary policy. Joining me right now to talk more about that is the Wall Street Journal's chief economics correspondent, Jon Hilsenrath. Jon, it's good to see you this weekend. Thanks so much for being here.
Hey, Maria. Great to have you.
And when we talk about higher interest rates, we also have to talk about where we are in the economy right now. Things have been going well. The U.S. economy humming along. But are things slowing down on the horizon, Jon? How would you characterize things?
Well, I mean, I think 2018 will go down as one of the best years of this expansion. We had growth near 3%, and that unemployment rate got down to its lowest level in near 50 years. That's great news. It's a lot to celebrate at the holiday season. It does look like things are slowing down a little bit on several fronts. One is global growth has softened. China is slowing down. Europe is slowing down. So we started out the year with a synchronized global upturn. Now it's an asynchronous upturn. And one of the big questions for 2019 is, can the U.S. keep growing so strongly when the rest of the world looks like it's softening?
Yeah, that's absolutely right, because we did start with this synchronized global growth story, but that told us once again that we're all connected. And when you see what's going on in Europe, for example, Jon, Brexit uncertainty in Britain, fires and rioting in France,
right.
You know, Italy and their budget issues, doesn't that have to impact the U.S. at some point?
Well, you know, it looks like it's starting to impact the U.S. a little bit. So the last set of GDP numbers that came out, we saw really strong consumer spending growth, but the trade deficit was widening. So it looks like the global picture is having some impact on the U.S. And then also we can't forget that financial markets are globally connected. And, you know, the slowdown, we have a lot of multinationals that earn a lot of money overseas. We're seeing stocks really tumbling the last couple of months. So that's affecting the U.S. as well.
Yeah, let's talk the Federal Reserve for a moment, Jon, because the Fed has done a bit of a pivot, in my view. First, we were expecting consistent rate hikes throughout next year, 3 at least. But then, you know, Jay Powell says, no, we're looking at 2. And even then, the market sold off, meaning that the markets don't even believe that, you know, he can stick to 2, given the slowdown that we're all experiencing. So what's your take on the Fed? What did you hear from Jay Powell this week?
Well, I mean, it sounds like the markets wanted the Fed to just say we're done, to just stop raising interest rates at this December meeting. And what Powell said is we think we'll probably do more. We don't know how many and when. You know, I think one of the really important factors to watch for the next couple of months is oil prices. Oil prices have come down quite a lot. That's putting downward pressure on inflation. So as we go into January, February, March, I think it's going to be hard for the Fed to raise interest rates again when the headline inflation numbers are so soft. It might buy the Fed a little bit of time and put off any further increases until the middle of the year.
Well, I think you make a really good point on oil, because on the one hand, the fact that oil is down 20% in just the last couple of months would be a positive for the consumer, because they're seeing lower gas prices. That's putting more money in their pockets, obviously. But the troubling part of this decline in oil is it could be indicating that this global growth story is a lot more severe than we thought. What do you think it is?
Right. Well, you know, the oil dynamics of the American economy itself have changed a lot in the last decade because of fracking. So we used to be a net importer of oil. Whenever oil prices fell, it was good news for the American consumer. It meant more money in your pocket after you filled your car up at the tank.
Right.
But now a very important part of this economy is driven by oil. The Texas economy, North Dakota, Wyoming. When oil prices fall, that means less rigs going in the ground, less business investment. So the business investment cycle here in the United States is now more closely tied to oil prices. So it isn't a uniformly good news event when oil prices fall.
What about earnings, Jon? I know we're not seeing much inflation, but there's still this issue that companies are seeing their input costs go up, commodity prices going up, and that's squeezing profit margins. We had earnings growth of 25% year over year for 2018. But next year, most analysts are looking for growth in profits of like 7 or 8%, could actually go down to 5%, I heard at the end of the week as well.
Right. So there were two big tailwinds early in 2018 for profit growth. The first one, of course, was tax cuts. The corporate tax rate was cut from 35% to 21%. So, everybody got a big boost there. And then we also had the global growth story. Well, now as we progress through 2018, the benefits of those tax cuts, the initial really big impetus, has faded. But we've also gotten a lower unemployment rate, and we've got wages picking up. That's great news for consumers. It means more money in the pockets of households. And by the way, I think we'll see that at Christmas time in the consumer spending. But it creates profit margin pressure for companies. And so the combination of tax cuts and higher labor costs for companies means the